Good afternoon. Welcome to Advisory Live. We're powered by Nasdaq IR Insight. I'm your host, Will Briganti, and joining me today as my guest is Masoud Ghaussi from Nasdaq Advisory Services. Masoud, it's great to have you back on the program.
How's it going, Will?
It's going well for April 3rd. Thank you very much. So the last time you were on the program, the markets were entering correction territory, and it seems like stocks have not really recovered their losses since. So what's going on there?
Yeah, so to your point, we were, or I guess we are in correction territory, correction being from peak to where we are now. We experienced about 10% of losses. Usually a bear market is 20% losses. We're not there, so we are going through a correction. The reason why it hasn't picked up recently is three things have come to the forefront since we last spoke. One, anti-trade sentiment. Two, protectionist policies, mainly in the form of tariffs. We saw the steel tariffs, aluminum tariffs, slapped on by the White House, and also China retaliated on Monday, hitting a lot of the farm industry in the United States. So that has been the second reason. And the third reason has been led by the tech industry. A lot of the FANG names, so-called the Facebook, Amazon, Netflix, and Google have been taking a heavy beating, despite the fact that their fundamentals are strong, reason being potential regulations in and around the tech industry because of privacy issues, and also with the presidential tweets we're seeing, issues surrounding the post office and Amazon. So those two things are contributing to sort of a dampened environment in the U.S. equity markets. Okay. If I may shift gears a little bit and change perspective more from a quantitative standpoint, if we look at deal making, spreads, despite the fact that M&A activity has been extremely robust and off to a record start this year, deal spreads have widened. Last year, this time, we saw deal spreads around 4%, currently at 8%. And by deal spreads, I mean the current share price versus the announced acquisition price of a company. And the reason why the spreads are widening is because, the premium. The reason why the spreads are widening is because investors are pricing in more risk. And the risk that we're looking at is essentially government stepping in and slapping down some of these deals, stating that they can't go through. So more scrutiny, I guess, around cross-border deals, more scrutiny around large acquisitions, and that's being priced in.
And what about some tailwinds? Anything about tax cuts there and deregulation?
Yeah, so tailwinds have been, as we've mentioned consistently over the last few months, tax cuts and deregulation. So that has been serving as tailwinds. In terms of GDP growth, it has picked up. We're looking at closer to historical norms, and we're looking at good, solid earnings growth.
On the topic of GDP, how is the state of the economy?
Yeah, so the economy is on a solid footing. If you look at polls across various and many economists, they're all very bullish about the state of the economy. If you read the outlooks of a lot of the institutional managers, the likes of Fidelity, Wellington, they see the U.S. economy growing over the next year or so. So the state of the economy is strong. Various data points are coming at encouraging levels. We are potentially seeing some signs of deceleration, especially with respect to Q1 GDP figure. However, probably not a source of major concern at this point. To my earlier point, we are looking at GDP growth which was revised up in Q4 to 2.9%. Q3 was around 3.2%, and Q2 was around 3.1%. So moving closer to historical norms of 3.3%.
Okay. And what about corporate earnings? Those seem to be healthy. Is that correct?
Yeah, so state of the corporate sector is very healthy. 3 points here. One, if we look at historical earnings over the last few quarters, it has been, EPS growth has been in the single high digit to somewhere in the teens. Q4, we saw both EPS and revenue growth. EPS growth of about 15%, revenue growth of about 8%. And going forward, next quarter, we're projecting EPS growth of 18% in the high teens. So that's very encouraging, very strong. And looking at the tech sector, which is experiencing some heavy beating in the equity markets right now, it's set to grow, I think, over 20% or so. So again, the corporate sector, the state of earnings is very strong.
Awesome. I think we just have time for one more question.
Sure.
So any final takeaways for our audience today?
Yeah, so quickly wanted to touch upon valuation, looking at a P of 16.2 times, historical look back between 15 and 17. So valuations have come off slightly from the highs we saw around January at 18 times. Other points I wanted to mention, one, leverage ratios are going up. A lot of companies are piling on more debt,
Right.
especially triple B bonds. So if the market does turn for the worse, this could potentially exacerbate the contraction. So that's a source of concern. And finally, jobs report this Friday. And finally, yes, I'm sorry. So just the jobs report this Friday.
Yeah, of course. Okay.
Yep.
All right. Well, Masood, I appreciate your insight.
Absolutely.
We'll leave it
Thank
there
you,
for
Will.
today. Okay. Thank you so much. Ladies and gentlemen, Masood Gausi, an analyst here at Nasdaq Corporate Solutions. For more information on all of the surveillance work that Masood and the rest of the team here at Nasdaq Corporate Solutions do, be sure to visit our website, business.nasdaq.com, and look in the Intel section for our IR solutions. We appreciate you tuning in to the April 3rd edition of Advisory Live. Masood, thank you very much.
Thank you, Will.
Have a great afternoon.